Well, certainly what we provided today was some guidance around the various moving parts on margin. And as you would well understand, there are a number of aspects that move that contribute to the margin. And that's deposit pricing, that's pricing on our asset side, also what the cost of wholesale funds are doing, and the basis bills spread risk as well. What we are doing is we're not providing outright guidance. There are a number of moving parts, but we have seen growth over the last 12 months to 1.98% NIM, a 5 basis point improvement. And that largely came about through managing our TD portfolio, sourcing low-cost deposits through our owner manager network, and also through on the asset side as well.
Well, talk to us about the cost environment, because we have seen a big repricing in loans, not just by you, but by a number of the banks lifting their variable mortgage rates for owner-occupiers. I think you're up by about 9 basis points or so. Banks citing the higher cost of funding. Do you expect that challenge to remain going forward?
Well, there are a number of structural changes that we're seeing in the marketplace at the moment, and that's certainly around the cost of wholesale funds, particularly sourced from offshore. We've also seen a much higher cash to bills spread. It's around 50 to 60 basis points. And if you look at the previous cash to bills spread, it was probably more around 20 basis points. So that has flown through into some of the costing for the industry as a whole.
And Jon, can you give us a better idea of what you're seeing in the economic backdrop as it pertains to your business? I mean, we've heard the RBA recently raising some concerns about household debt in particular. How concerned are you about this specifically?
So let's just look at the general specifics for the Australian economy, growing at about 3%. We actually have a very large SME lending portfolio, particularly in our leasing business, and we're actually seeing increased demand from a lot of our customers to actually continue to grow their businesses. There's no doubt that there has been a lot of press, a lot of discussion about household debt. What I am seeing is a slowing in household prices, or a decline in Sydney and Melbourne key markets. I don't think that's a bad thing. I think that allows some of the first home buyers to get into the market. You've got interest rates at very low levels, and I think that will continue to remain the case here in Australia. You've got a little bit of green shoots around wages growth, which is good, and I also think that we have a very low unemployment rate, and that's helping support the economy. So I think the outlook is still quite strong for consumers.
Given that outlook, would you like to see the RBA move quicker when it comes to rates? Because you're talking to Matt about the outlook for net interest margins. Surely that would help you on that front.
Well, I think the RBA will make their own decisions about what they do with official cash rates. I think what is really, really important is that the Australian economy actually continues to grow, and it is growing nicely. And with a growing economy, that will support households. And we are starting to see a little bit of growth in wages, which I think is a good thing as well for consumers in the market. And it's very difficult to predict where interest rates may or may go, official rates. But I think that, for a while longer, we're still going to be in this period of very low rates in Australia.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now, to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.